The Fed's about to unleash a massive liquidity crisis. I'm your host, Steven Van Metre, and thanks for joining me today. And with quantitative tightening set to start today, the Fed is going to drain liquidity from the markets and bring volatility back as they attempt to bring inflation down. And several of you have asked if I could cover in detail how quantitative tightening works. Well, today's your day. Now we're going to head over to Bloomberg, where I want to set the story up so you understand what's going on and how it affects the markets, and then we'll get more into the mechanical workings and what's really going to happen. So we headline with Bloomberg, Fed starts experiment of letting 8.9 trillion portfolio shrink. The first assets will mature without reinvestment on June 15th. Which actually begs the question is, how is it starting today? If that's what Fed Chair Powell said, when it's actually starting on June 15th? Well, we'll get to that in a moment. After doubling in size through asset purchases in the first 2 years of the pandemic, the balance sheet will be reduced at a pace that's almost twice as fast as the last financial crisis. And while the process officially commences on Wednesday, the first U.S. Treasury securities won't run off until $15 billion mature on June 15th. And that's the interesting part of the first part of the story, is that Powell knew when he announced that quantitative tightening would start on June 1st that it wasn't actually possible because the first securities don't actually mature until June 15th. So we've got another 2 weeks before it officially kicks off, but we'll get more into that in a bit. The Fed is capping the monthly runoff at $47.5 billion, $30 billion for Treasuries, and $17.5 billion for mortgage-backed securities, and up until September. And then those caps are going to rise to a combined $95 billion, which compares to a peak of $50 billion a month when the Fed performed the exercise starting in 2017. And just so you understand, the cap means that's as high as they will go. If they don't have enough maturing securities that month to reach the cap, then they're going to stop at the mature amount of maturing securities. So the cap is indeed a high water mark. Officials say the reduction will work in tandem with interest rate increases to cool price pressures by tightening financial conditions. And that's something we talked about in yesterday's show, that the Fed has no choice. Because rates are rising, they have higher cost to provide to their balance sheet to the people holding these securities. Well, what do they have to do? They have to get rid of them because they're already in a loss position that could only get worse. So they have to unwind these securities as they hike rates. It's important to understand. But it's not clear how much the impact on the balance sheet will have. As Fed Governor Christopher Waller put in a speech on Monday, estimates using a variety of models and assumptions are highly uncertain. Well, not really, but we'll show you. Uncertainty over the course of the balance sheet was said by commentators to have contributed to the market turmoil that ultimately helped bring an end to the Fed's last rate hike campaign, which concluded in December 2018. Now the Fed is also raising its benchmark rate at a faster pace in a bid to tighten financial conditions and tame inflation, which in recent months has reached the highest level in 4 decades. And minutes of the Fed's most recent policy meeting on May 3rd through 4th said that regarding risks related to the balance sheet reduction, several participants noted the potential for unanticipated effects on financial market conditions. Well, those unintended market conditions aren't really unintended. They actually know what they are. It's called volatility. And when volatility comes back, well, yet usually it's not good news for stocks. Let's check out this chart here. And what we're seeing is the monetary base, or the Fed's balance sheet, overlaid in red here with the VIX, or volatility index. And what you see as here's quantitative easing 1. This, as the blue line is rising, then you notice how it stops. Volatility comes back, and then they do quantitative easing 2, and volatility comes down. And as soon as it ends, volatility is back. So they bring in QE3, volatility subsides, stays low, and as soon as they start to end QE3 right in here, volatility starts to spike back. The market gets used to the fact that now there's really no more QE, and then the unwind starts right here, right kind of at the beginning of this arrow, and runs to about the tip. And notice we see volatility spiking back. There's absolutely no question about what is coming. There's going to be a lot more market volatility, and at a time when people are cramming into equities on a bet that we're going to new all-time highs, well, the balance sheet runoff says, well, maybe not so fast. As Treasury market faces liquidity risks as Fed pairs of balance sheets, according to this opinion piece. On the margin, we should see a little bit weaker liquidity in the Treasury market because there's no opportunity to sell bonds from dealer balance sheets to the Fed. Well, here's the thing. Yes, liquidity in the Treasury market is low, but guess what? The Fed had already stopped rolling off its balance or stopped buying securities a while back. So that is not really an issue right now. The issue is rates have gone up and people just aren't all that interested in buying bonds right now. And that's why liquidity is low. But that soon will change. That might increase volatility, but liquidity is also pretty thin within the rate space, and it's not nearly directional. The risk is that the market is unable to absorb the additional supply, and you do have a bit of adjustment in valuations. And yes, we are going to challenge that statement by the end of this show for sure about this whole supply issue. We will still see more long-end supply than we did pre-COVID for quite some time, so all else being equal, that should pressure rates a bit higher and the curve a bit steeper. And bonds rally everywhere in May, with bulls saying the sell-off is over, according to this headline from Bloomberg, as asset managers, including pension funds and insurers last week, ramped up bullish wagers on treasuries to the highest level since April 2020. At the same time, JP Morgan, Morgan Stanley, and Pacific Investment Management have all gone on record saying the worst of the global debt sell-off looks to be over. And if you aren't worried about a recession right now, you're getting closer to the point where it's an attractive entry point in the market from the credit or fixed income side. We're positive on investment grade and selectively high yield in Asia, he said. And that's actually the whole point, is during recessions, what happens is growth falls and inflation falls. And when growth and inflation falls, interest rates fall and bond prices go up. And if you're concerned at all about what heightened volatility means to the markets, well, you shouldn't be. Be sure to check out Portfolio Shield. It's a strategy that actually can hedge with long-term bonds designed for markets like this. I'll put a link up there in the corner and in the description below. You'll be glad you did. Now, let's talk about the mechanical side of what's going on with this QE or QT, because a lot of people, they just don't understand actually how it works. So let's take you back to the beginning. We'll want to just step you quickly kind of through QE, so that way quantitative tightening will make sense, because it's not actually the reverse. A lot of people think it is. It actually isn't. So where does QE start? Well, it starts with a customer deposit into the commercial banking system. So for example, if you bank at Bank of America, JP Morgan, or Wells Fargo, well, this is where the process starts. When money is deposited into one of those banks in the commercial banking system, well, the banks have two things that they can do. They either can lend the money out, because obviously they have to pay you interest, or if they don't have enough demand for loans, well, they can turn around and buy an interest-bearing security, which can either be a U.S. Treasury or mortgage-backed security. And that's how a bank reserve is initially created. And all the Fed does at this point when they do QE is they come along to the bank and say, hey, we'd like to take that Treasury or mortgage-backed security from you, and in exchange, we're going to give you, as my buddy Jay Bravo says, a token or a placeholder, an accounting entry to put on your balance sheet to show that you still have it, and we're going to take this over and we're going to hang on to those Treasury and mortgage-backed securities. Now, if you're having a little trouble with this concept, think about this. If you've ever valeted your car, well, what happens? You give the valet your key, they give you a ticket. Now, a car wasn't printed, nothing changed here, and all you have is a claim on a car, and that's what all the Fed is doing, is they're giving the banks a claim back on the securities that it took. Notably, the Fed doesn't print money here because the Fed doesn't have the ability to do that. Now, where does quantitative tightening come in? Because we've just covered the whole process of QE in a matter of a few seconds. So what the Fed's going to do now is they're going to let these U.S. Treasury and mortgage-backed securities roll off its balance sheets. They're going to let them mature. Now, when a bond matures, whoever issued the bond has to pay the holder of the maturing bond the par value. So what's going to happen, and we'll focus now on the Treasury securities, is the U.S. Treasury itself is going to pay the Fed. They're absolutely going to pay the Fed the par value of those bonds. Now remember, we talked about this briefly a bit ago, is the Fed can neither create nor destroy money, so they have this cash now from the maturing bonds. Well, what are they going to do? They're going to swap that back with that claim token and give the cash back to the banks. So where the cash started with a customer deposit is exactly where it ends. The customer deposit is still there, and now the banks have the cash back. And so we come all the way back to step number one, which was what happens after a customer deposits money in the commercial bank. What do they have to do? One of two things. They either have to lend that money out, or they have to buy an interest-bearing asset. Now, here's the question I want to ask you is, do you think that commercial banks have enough demand in loans to absorb $47.5 billion worth of cash coming back to it? Well, they don't. So that means the banks are going to turn around and do what? Buy Treasury securities again, and maybe mortgage-backed securities. You get it? So nothing is really changing. The only question is, who owns these bonds? And so that means the banks have to come in. But unlike when the Fed is doing QE, where the Fed dictates to the banks, it says we will only buy these certain amount of securities and of these certain lengths and duration, the banks now have total control. And that is one of the reasons why we tend to see rates fall during QT. Now let's go look into this picture here. Hopefully that is a good explanation that makes sense to you. But here we see from the Fed's website that they're going to roll off $30 billion of Treasury securities and $17.5 billion of mortgage-backed securities. They're going to do that starting in June, and they're going to run that through September and then increase those numbers to a total of $95 billion. Now, this will have an effect of somewhere between a quarter and a 50 basis or 25 and 50 basis point rate hike per month on top of whatever the FOMC is going to do in 2 weeks and in the following months. So this is effectively raising rates without directly raising rates. And I want you to understand that that does have a major impact here. Now, if we know, how do we know this isn't starting until June 15th? Well, I pulled up the security holdings of the Fed, and sure enough, starting on June 15th is the first note that is going to mature at almost $15 billion, and then at the end of the month, they've got another note of the same interest rate maturing around $15 billion, which gives them the $30 billion cap they need. And how do we know what that is? Well, they're 3-year notes, because we can look up the CUSIP number, and we can see that they bought these 3-year notes. Well, when this was issued back in almost 3 years ago. Here we go, auction date, and you see original issue date of June 17, 2019. So what's going to happen then, and this great piece by Morgan Stanley Research is it's showing the total maturing U.S. Treasury and securities and mortgage-backed securities, and you can see for a while through early 2024 there's no problem. The Fed has a ton of securities rolling off its balance sheet, and then as we get into late 2024 and into 2025 and on, presuming they're still doing it, there just aren't enough. So the Fed will be unwinding everything, but they will not get to the cap. Maybe they will end up selling them, but that's a story for another day. And as far as the demand for these bonds, well, I want to point out that we looked at this in a previous show where the Treasury is going to start issuing fewer and fewer 2, 3, 5, 7, 10, 20, and 30-year notes and bonds, and that means the banks who have to buy these, because we're assuming again they don't have a massive amount of lending demand as it is, which we know they don't, are going to have to buy bonds, and that means there's going to be fewer issued, and they still have to turn around and buy them. And that you start to get why rates end up coming down. Well, that's not the only reason why. It has everything to do with demand for lending. And some people said, hey, wait a minute, under last time we did quantitative tightening, rates went higher. Well, why did that happen? Well, when we look at the mortgage refinance index, which went down again last week now, we look back to quantitative tightening, which started here, and there was still demand for mortgages, but they kind of ran out of steam right around the end of 2018. And then quantitative tightening doesn't end until up here where there's more demand for mortgages. So here's the start of quantitative tightening. Here's the end of quantitative tightening. And notably, here's the start. Here's the end. There's the peak. The peak has more to do with the fact that there's no lending demand. And so what would the banks come in to do to try to spur the growth of lending, to sell their product, which is loans? Well, they would buy predominantly more long-end securities, bring the rates down, and that should bring people back into the bank. So as you can see, all the Fed's doing is giving control back to the banks, who now can decide what securities they want to buy. And now you know why. They're probably going to target the long end of the curve. And due to a decline in lending demand, we're going to see rates fall at a time market volatility is going to head much higher. I'm Steve Van Metre. Thanks for being fans. Thanks for watching. Bye now.